Okay, no, but please keep asking questions. It's more important that you get out of it what you want to get out of it than that I say what I want to say. So if there's something I say that triggers something, then please ask the question. Taxes, you're not obligated to pay anything more in taxes than what you actually owe. And the code is very much full of opportunities to reduce your taxes, especially charitable donations. And the government really wants us to support Meals on Wheels, Food Shelves, Courage Center, Habitat for Many other organizations, because their statistics have shown that we in the private area can produce with 50 cents the amount of services and products that would cost the government $1. And for me, Habitat is the best example of that. That if the government contracts to build a house, it will cost twice as much as what Habitat can build it for, because Habitat has volunteer labor in addition to, in some cases, donated materials. So it's very clear the government wants us to support charities. I personally would like to see the tax rates increase significantly. I mean, I'd like to see a tax on the rich get up to about 80 or 90%, because it would create an incentive for them to think in terms of supporting other institutions. Whether it's they don't want to support other institutions, fine, let the government get the money and run the government. Whether they do, they can help make a difference in the world with their donation dollars. So, if we understand taxes, we need to understand our tax brackets. So here for 2014, standard deduction. Well, standard deduction, as most of you know, is that amount that the government gives each one of us as a reduction from our taxes, and it doesn't matter whether we own a home, don't own a home, and stuff like that. There's some extra incentives for those, but that's the first part of what we earn that we don't have to pay tax on. The other thing is our exemption, and this year it's $3,950. That also is our first part that we don't have to pay tax on. So if we combine these, if we look at a single person situation, either less than 65 years age or over 65 years of age, you see that the zero tax bracket for a single person is like $10,150. So if you have somebody that is making less than that, they don't pay taxes at the federal level. And I got to keep saying that because I want to show you an example that you pay no tax at the federal level, but the state of Minnesota stocks it to you. So, and then you pay 10% on the dollars over that amount, up to $19,000 in the case of a single person, or $20,000 if you're over 65. Then the 15% bracket starts at 20 and goes up to 47 or 48, depending on whether you're. And then there's two more brackets, 35% and 39.5. So, but I didn't put that on there. Irrelevant for the right now. So for couples, that means that a couple is in the zero tax bracket for the first $20,000, and that doesn't include Social Security. So you can see a retired person or a couple that maybe each have, $15,000 of Social Security. You could have $50,000 of income and not pay any taxes as a retired. But they'd have $20,000 of other income from retirement accounts plus their Social Security, and so the first $50,000 is really tax-free. And then they got 10% up to $38,000 to $40,000, and then 15% up to $94,000 and $96,000. Well, now why are these things important? Well, let's look at capital gains. The capital gains tax is a tax on assets that increase in value and they're sold, like stock, mutual funds, because inside the mutual funds, the managers buy and sell stock all the time. They sometimes generate capital gain. Well, a few years ago, the government decided that, well, not only is the gain itself going to be taxed at a capital gains rate, we're also going to tax the dividends on those stocks at the same rate. which is, so you now get a capital gains rate on dividends from stock as well as capital gains rate on when you sell the stock. And what's really important is to understand that if you're in the 10 to 15% tax bracket, in other words, a couple that's retired up to as much as almost 100,000, they pay zero tax on their capital gains. So if they've got stock with dividends or they've got stock they sold, they don't pay any tax on any of that. So let's look at an example. So in this case, they use a single person over 65. They got $4,250 in interest, dividends at $34,500, IRA at $26,500, Social Security at $14,600. So they got total cash. That's not necessarily taxable because only part of the Social Security is taxed. They got $79,850. They're also very generous people, or this guy's very generous, happens to be donating and has a house and some interest, and so his total deductions are $40,000. Now, in order to understand where the zero capital gains tax kicks in, is that the deductions go against all the ordinary income first. So in this case, we have $40,000 of income of deduction. That wipes out your interest. It wipes out the out the IRA. It wipes out the Social Security. So what you have left then is the $34,500 in dividends, and you had taxable income of $33,760, which means that all of that taxable, quote, according to the IRS, is your dividends, so you don't pay any tax. So here's a single person with about $80,000 paying zero tax at the federal level. As I said, the state of Minnesota is not so generous. They're going to tax those dividends and collect $2,000. Those of us who live in Wisconsin is more generous. Because they take that dividend and they have a 60% forgiveness on the capital gains part, not necessarily on the dividends, but on the capital gains part. We still pay tax on some of it, but not on the whole thing. So you can understand, when people talk about lowering taxes, who's yelling about lowering taxes? I mean, you don't have very many retired people making significant dollars complaining about the tax rate. Because the reality is they're paying very few taxes, Maybe working people, yeah, definitely. They're probably the highest tax brackets right now. So, understanding taxes, now understanding buying. You're spending money. So what is the choice between the 10-cent per cup coffee at home and the $2 cup at the chain? As you said, it's probably understated that significantly. If we reframe that and say, I haven't put away enough money into my retirement plan, IRA, 401k, whatever choices you have, and I'm 40 years of age and I'm going to need that money when I'm 70, what is that $2 coffee? Well, it really costs you $17.45. Or that McDonald's is, or I'm sorry, rephrase that. The McDonald's, it was $17.45. If it was the $2 coffee, it really cost me $31.40. I got that backwards. Versus the 10 cents for the cup of coffee at home. And so you could go out and buy a coffee maker. You could buy one of these cups that keeps it hot for 4 hours. You never need to buy anything at any coffee place, not even McDonald's. So, like I said, if you did what we say here, that would destroy the economy. So, and we can carry it to the jeans. If we're looking at the difference between a $15, $30, or $50 pair of jeans, we're really looking at a difference between $15, $101, or $235. Do you really need a $235 pair of jeans? Or if we're buying cars, and I think this is where the big money is lost. $15,000 cars will get most of us around where we need to go for a 10-year time period. And if we buy that rather than the $20,000 or the $30,000 car, we're really talking about a difference between a $15,000 or $87,000 or a $265,000 car. Do you really want to buy a $265 car? So, I'm just saying this is a way to reframe how you look at your purchases. I'm not saying you have to quit buying more expensive cars or more, but think about it, you know. If you're not fully funding your retirement plan, if you haven't got enough money put away to live comfortably when you want to, you need to seriously consider we're paying the extra $5,000 or $10,000 or $15,000 for a vehicle is worth it. And this is going to happen every time you do that. So if you buy every 5 years, you know, you're talking about this, you know, I could run a 30-year projection of how much money that really costs you. But, you know, I'm just doing a one-time deal. So every time you spend money, from my perspective, you need to think about the alternative. And if you've clearly got enough money, that's no problem. But sometimes immediate gratification is worth it. Yeah. So spending money for a little extra is certainly worth it. You know, you're not going to take anything. But I think if you get in the position of doing always the immediate gratification, then you suffer in the long run. When you reach 50, 60, 70 years of age and you want to do something and you don't have enough money, you can think back to those times when you probably could have delayed gratification a little bit. Credit cards. Necessary evil. Well, maybe. Somebody says they're going to go away or they're going to be replaced by chips and who knows what else. But it is the biggest problem for most people for two reasons. One is the interest rate. You cannot invest your money any place and make a reasonable 13 to 22%, which they're going to charge you if you use a credit card. So if you're borrowing money and it's costing you more than you could invest money, then you have to decide whether it's really important to borrow the money. So that is one problem. The other problem is that because buying with a credit card is instant, there's instant gratification, but there's also the fact that you make impulse decisions. If you didn't have the money in your pocket when you walked into the store and you saw something you liked but you didn't have the money, you'd probably wait till it went on sale, or you'd wait till some future date and plan for it and buy it. So with a credit card, that's the worst thing about it. People seem to think that it's instant money, but there's a long-term cost involved. You know, and that's why college students, and you know, now we got to back up and talk a little bit about financial training. You can go to the University of Minnesota and get a degree in business and never once take a course on personal finance. Never once learn how to manage your own money. You know, you'd think the institution that's kicking out financial planners and who knows right and left would at least have a course to teach people how to manage their own money. They don't. And that's across the world. You know, we do not share the information we have with those who could use it. Okay, so I'm doing a simple example here. Let's say you want a room for old furniture, costs $2,000 or $2,500. If you save $2,000 a month for a year, you have pretty close to that amount. If you borrowed it on a credit card that pays or charges you 15%, you're going to have a payment each month of $225 over that 12-month time period. So the difference between the 200 and the 225, that's, you know, right off the top, $25 better off per month. You also would have saved yourself some interest during that time period. You might have made some money where you put the money during that time period. Again, just a reminder, you don't borrow money for things that go down in value. A credit card is a borrowing tool. It's borrowing money. Now, if you borrow it for 20 days and you pay it off in full each month, that's fine. Because you're not charging any interest, it's not costing you anything. And in today's society, there are some advantages to it. But I carry a lot of cash because, especially when I'm traveling outside the metro area, there are many, many businesses today who will not accept credit cards and will not accept checks. So they have decided that the cost of the hassle of dealing with that kind of problems, and they have a discount for people who pay cash. So it's something to think about. Sometimes not using a credit card can actually save you some money on the cost of your whatever you're buying.